So we're going to assume bonds have a 4% return. For bonds, it is pretty straightforward. Your expected return on bonds really is the current yield. If you did analysis of 10-year bonds, 10-year treasuries, if your forecast was the starting yield, you would have a pretty good forecast. It works pretty well. Even if you're putting new cash in every year. For stocks, we'll talk about how I came up with stock return. Standard deviation is probably based on history. Stocks, this is actually a little bit high, but you'll see why I fudged the numbers here. I'm kind of cheating. There's our formula for the risk of a portfolio of two assets. So let's say correlation is 1, 0, or -1. Those are the choices, right? And in between, you can't have anything greater than 1. You can't have anything less than -1. So what is my risk? So here we go. We're going to take the weight of the bond squared times the standard deviation of the bond squared plus the weight of the stock squared times the risk of the stock squared plus 2 times the weight times the weight times the risk times the risk times correlation raised to the 0.5, and you would assume that's 4% because it's 100% bonds, right? So if we copy that across, what's going to happen as we go across? It's going to be a perfectly straight line because the correlation is 1. So if we map that, nothing interesting there, just a straight line. Pretty straightforward. What else is a straight line? Well, return. What's the formula for return? Return is really simple. It's the weight of the bonds times this expected return plus the weight of the stocks times this expected return, which is just 4%. And as I copied that across, it's just going to go up very linearly. So if I have my risk, sorry, I used to be faster in Excel. I've slowed down in my old age. I'm sorry, didn't mean to do that. So if I insert an XY chart, it's just a straight line. As risk, as your weight the stocks increases, your return goes up and your risk goes up. Very straight line, not much value there. What's going to happen to this line as correlation goes down? How's this line going to shift? Flatter, not, but it won't be a line. So it's going to start curving, right? And how's it going to curve? Is the risk going to go this way, or is no? So let's try it. All right, let's try correlation. It's hard to get them all in there together. But what if correlation is 0? I forgot to lock something in. Oh, I can't, sorry. Between, all right, let me. All right, between Zoom and Bill Gates, I got to figure this out. All right, so what do you notice about risk here? Risk went from 5.4% all the way down to 4.02. What happened to return? It's the same, right? There's no change in return. So the only thing we're doing is reducing risk. So when we graph this, we get something that looks like what? You'll recognize this? That look familiar? The efficient frontier, right? So the question is, where was that original line? The original line was right here. So what did the correlation do? It shifted our return up at the same level of risk, or it shifted our risk to the right, to the left. So at each level of risk, we have higher return. So this is return over here. This is risk down here. So as you reduce your correlation, this line starts bowing out to the left. It's always superior. What happens if correlation goes to -1? What will this look like? It's going to keep bowing out, right? And if you have a -1 correlation, what's one unique risk number you can get? Let's see. If I copied it down right. Anything look interesting there? I didn't get it exactly right. I was hoping to get 0. I didn't get 0. Let's see if I can get 0. Yeah, right here you get a num because you're getting a divide by 0. So I can't quite get it exactly at 0. But there is a point in there somewhere where there's an allocation that will get you exactly, oops, sorry. So when correlation is -1, you'll actually have a point that has 0 risk. All right, because if two things are negatively correlated, you put them together, you can eliminate all your risk at some point. At this point right here, at a 5% return, you have 0 risk. So if someone says, what's your expected return at 0 risk? What do you always say? Don't say 0. You say what? Your expected return is 0% risk. It's the risk-free rate. All right, always make sure to say that. This should be a trick question I have to add to the exam. And not, or you. So where was our original line? Our original line was just a straight line from here to here. As correlation drops, the line starts shifting out and to the left. So you get higher returns at each level of risk, or you get lower risk at each level of return. So there's the original line. The 0 correlation shifted like this and went like that. And then -1 correlation shifted it pretty dramatically over here. I could get you the exact 0 point if I could find it. Somewhere in there, there's an exact 0 point. If I played around with the numbers, I could probably get it. Yeah, it's not going to work. But that's what that correlation does. Most correlations are more in the 0.9 level. What does that look like? Correlation of 0.9? Can you tell that from a straight line? Looks like a straight line, doesn't it? When correlations are 0.9, 0.8, diversification doesn't help you all that much. It helps you a little bit, but it doesn't help you all that much. So let's go back and see what I did. I got an expected return, expected risk. I'm taking different allocations in 10% increments. My expected return is real simple. I just take the weight in bonds times this return plus the weight in stocks times this return. Return is simple. It's just a weighted average of the two. For risk, I have this crazy formula. You square the weights, you square the risk. Do that for each asset class, then 2 times the weight times the risk times correlation. Take the square root of that, you get the risk of the portfolio. If the correlation is 1, then risk becomes nothing more than the weight of A times its risk plus the weight of B times its risk. That's all it is. It's just a straight line all the way across. So when correlation is 1, there is no diversification benefit. The only way you reduce risk is by having less of the riskier asset and buying more of the lower risk asset. That's the only way to do it. All right. Have y'all built efficient rotators in a class? I know Dr. Vipin does it in his class. In this class, I give it to you already built. Maybe I can show you the model. We're going to get into it more detail in a future class. When we talk about the second project, I don't want you worried about it too much yet. But We're going to have 9 asset classes. Here's the returns and the risk. Here's the correlation table. Remember I was talking about that kind of triangle thing you're going to have. So you have the correlation of large cap growth stocks. The large cap growth stocks, they're perfectly positively correlated because they're the same thing. But then as you go to different asset classes, you get different correlations. And then value, I don't need to do value to growth because I've already done that here. Right? That's why it's missing here. I think I saw Dr. Vipin, I've seen somewhere it's actually a rectangle. I do them both sides, but I don't do it that way. This is the more normal way of seeing it. So you get this triangle. You see any negative numbers in there? Not a lot, do you? So we're assuming bonds are negatively correlated to small cap growth. Does that make sense? You have to kind of think through it. Why would growth stocks be less correlated to bonds than value stocks? So why do growth stocks hate interest rates more than value stocks? So what is a growth stock? It's a stock that a lot of its value is way out into the future because it's growing really fast. When you have a cash flow way out in the future, what happens when interest rates change? It has a bigger impact, right? So growth stocks are going to be more sensitive to interest rates than value stocks will be. You see that, but it's all over the place. I mean, the history, this is all based on history. Obviously, high yield bonds are more correlated to stocks than regular bonds are. Gold, you don't see any negative numbers on gold. Should there be negative numbers on gold? Is no gold negatively correlated? I'm going to talk about that tomorrow night in the Investment Society. These are based on history. And I'll update this model. So I'll add another year. So if we see another year of data makes any difference or not. And so how do I run this model? Well, I have my allocation to the different asset classes. That gives me my return. And then my risk, look at how I do the risk calculation. I take the weights. So there's the expected return. I just take the weights times the return. That's pretty straightforward. The risk calculations, I take the weight squared, the risk squared, multiply those two together. That's the first part of the equation. And then down here, I've got to do the 2 times weight times risk times correlation for each one of those. So again, you're seeing that triangle, right? So that's how I set it up. I saw Dr. Vipin's, he does it differently, but this is the way I set it up. Just makes it a little easier to work. So you'll see this file. I just want to see that once you see this file, it's nothing more than what we just did in Excel here. Risk, you need this formula for 2 assets. For 3 asset classes, you just keep adding it. Returns, very straightforward. It's just weight times return for each asset class. Very, very straightforward. And as your correlation changes, where did I put it? I can't find it now. There it is. Okay. There's a correlation of 1. Watch what it does when a correlation goes to 0. Get that efficient frontier. Let me give you a little bit more room here to look at it. Yeah, I don't want to change that. I don't want to change the return side. No, that one's fine. Yeah, I want to actually change this axis. All right. So correlation of 1, just a straight line. 0, we shift out. -1, we go over to the side. But do you notice 0.9, 0.8, 0.7, 0.6, Doesn't seem to do much, does it? It's pretty immaterial, 0.4, 0, minus 0.1, minus 0.5, minus 0.8, minus 1. You got to get pretty low on the correlations for it really makes a big difference. And there aren't that many asset classes that are negatively correlated. And we'll talk that with stocks and bonds that are positively negative correlated. We'll get into that. So, finding something that when one's up, the other one's always down. I mean, that'd be wonderful. You could find something like that and they both have an expected return that's greater than the risk-free rate. That'd be wonderful, but those things just don't happen in practice. All right. I did that pretty fast. I believe every finance major should be able to build what I just built in under 20 minutes in Excel. All right, off the top of your head without any notes. How many of y'all could do that? I'll pay $10,000 so you can do it. Anybody want to come up and do it? Would you be more energized if I actually gave you $10,000 if you could do it in 20 minutes? How many of y'all would be able to do it on Thursday? So every finance major should be able to do it. This is so critically important. You saw in your banks, their number one price risk mitigation tool is what? Diversification. What is diversification? Putting together things that are not perfectly positively correlated. It's the number one tool for risk management in finance. You should be able to build it. Now, I did this with 2 asset classes. How long would it take to do it with 3 or 4 or 5? It gets a little more cumbersome to do, but you should be able to do the math. At USAA, we used the Ibbotson tool, which was a few $1,000s a year. And I finally said, forget it. We're just going to build it in Excel and do it ourselves. So we just built it in Excel and did it ourselves. And I hired my first hire ever was one of my students in my class. I go, Greg, you know how to write macros. I want you to automate our efficient frontier. Hired him right out of my class. It took I wrote the job description such that he was the only person in the entirety of USAA that matched the job description. So it made it really simple. And we had him, I think I set a record. He was sitting in his desk working 2 weeks after I posted the job. So the set a record. But what he did is he took our efficient frontier, he automated so a macro would run it. You could build the efficient frontier really, really quickly. You don't have the macro. If you want to build a macro, you could, but you're going to build an efficient frontier on your second project. And you can have a client. You're going to start them off somewhere. And then you're going to build an efficient frontier and make a recommendation of where you think they should be. Most people say, hey, let me go to a higher return, but I've seen other ones as well. You're going to see why I have a big problem with efficient frontier. We'll talk about that. There are some definite issues with it. But theoretically, it works pretty well. So this is what you're after. This isn't the only thing. We also do a historical VAR analysis. We do a style analysis, which I think is really, really cool. And we do manager attribution. So you're going to get to do several things. If you ever use the Morningstar software in an entry-level job, which you often will, essentially it's doing what this spreadsheet's doing, but you get to see the guts of it. So you can see what it's actually doing in real life. So this spreadsheet's pretty cool. I really like it. So you'll get to use that. I've done most of the work for you. You just have to enter the numbers and write about it. But everybody see how this works. Pretty interesting field. We can't go -2. That doesn't make sense. You get, wow, that's kind of interesting looking. You can't be +2. So your choice is between 1 and -1, but most asset classes are fairly highly correlated. When you get to stocks and bonds, you can get to lower correlations. So how did stocks do in 2022? Down about 25%. How did bonds do in 2022? Down about 25%. So if you're assuming stocks and bonds are uncorrelated, what did your client think in 2022? Well, you sure messed up. I thought I was diversified. Why weren't you diversified in 2022? What causes stocks and bonds to go down? I think we talked about this before. That one factor makes both stocks and bonds go down. Inflation. So if you assume stocks and bonds are uncorrelated, you're assuming what? We'll never have inflation again in the history of the world. Is that a good assumption for your client? Hey, you're well diversified as long as we never have inflation again. It's like, okay, that's good. Doesn't sound like a good strategy, but that's essentially what we're saying. And we'll look at that. That's a big problem we face from Frontier. You have to put an assumption in for correlation, and you have to assume it's constant over time. It never changes. We just know that's not the case. We'll look at that. We'll see it as we get into it. All right. Sorry, should have gotten here a little earlier. All right, so here we're talking about what happens to putting together a portfolio when you start bringing in this concept of correlation, diversification. So you don't want to have all of your eggs in one basket. And what that means is you don't want all of your assets to have a correlation of one. You want to have something less than one, and that reduces your risk without impacting your return, so that risk and return starts shifting to the left. So value at risk is impacted by that correlation because we're calculating value at risk using standard deviation, and standard deviation is impacted by correlations, so that's critical. Your value at risk is how much you expect to lose. Your risk budget or your risk limits is what you're allowed to lose. So I think we talked through this. So let's try a VAR problem. They're out there on Canvas. I recommend the first time you just watch. Don't try to understand it yet. So let me show you a word question first. This is from an actual exam question. This is not on next week's exams, so don't panic. You can panic in 2 months, but don't panic yet. The exam questions on exam 1 are the easier VAR problems, mean minus the normal deviation times standard deviation. But what I love about these problems is that these are pretty realistic problems. This is what you'd actually do. I've done this in practice before. So let's just read it and get a sense of it. You're recommending to change an existing portfolio. It has a VAR over $100 million. Your risk tolerance is 0.3%. Your boss wants to reduce the VAR below 70 million while maintaining or improving the expected return. So you got your objectives. You want a VAR reduced by 30% from 100 million down to 70, but you don't want to kill the expected return. That's a pretty high order. If you can reduce your risk and not hurt your return, how often would you do that? I do it all the time. Okay. If you can increase your return and reduce your risk, I would do that. If you can increase your return and not increase your risk, I would do that. So anything you can do which either reduces risk or increases return or both, that's what you want to do. All right. And you're considering adding 2 strategies, either A or B. You'll either put 10% in A and stay with the current, or 20% in A and stay 80% in the current, or you'll put 10% in B and stay 90% in current, or 20% in B and stay 80% in the current. Those are your options. So you have 4 options. And here's what your boss gives you. So if you look at it, your current portfolio has a 6% expected return, 6% risk. It's correlated 1.0 to itself. Strategy A has the same expected return, so that meets the criteria, right? If we add A, our return is going to stay at 6%, but it has lower risk. So that sounds good, right? We like lower risk, but it's got a 0.4 correlation to our current strategy. Strategy B has higher expected return, so that's great. If we add that, our return is going to go up. But man, it has has 50% higher risk. What does strategy B have going for it? It's negatively correlated. You're going to learn really quickly what's the most important number in this column. That negative 0.25. What you're going to discover, if correlation is negative, higher risk actually helps you. It's actually because you have something that's really risky, and when it's flying off the rails, it's probably going in the opposite direction of your portfolio. So I'm probably going to write the exam so you won't know which one's the right answer, but some of my early exams, it was pretty obvious. That negative 0.25 is going to help you a lot. All right. So what do we need to do? We need to do the expected return, the expected risk. We got to convert that into a VAR. So you got the current portfolio. Current portfolio's expected risk is 6%. Expected return is 6%. Expected risk is 6%. The portfolio was $1 billion, right? You remember that? So what is my VAR? Let's do it two ways. Let's do VAR as a percent. We'll do, because how did your boss express it? Yeah, she put it in dollars. So if it's in dollars, we got to do it both. So the VAR, you remember the VAR formula? Mean minus number of standard deviations times the standard deviation. Y'all remember that? That formula sounds familiar, hopefully. How many standard deviations are in this problem? I don't know what this stuff down here is. I can get rid of that. Anybody remember their risk tolerance? .03. So what number are we looking for in the table? 997. 0.997. Anybody see 0.997? How many standard deviations is it? 2.75. That look right? Okay. New files open. 0.75. So we take remember you do absolute value. So you do the mean minus 2.75 times the expected risk. That gives you a risk of 10.5%. You take 10.5% times the portfolio value. You get 105. What did she say it was? Over 100. So that looks pretty good. So that gives you one key that if your boss says the VAR is over 100 and you calculate and you get 60, you probably did something wrong. All right. So that's our starting case. So we could do 90 current and 10A. We could do 80 current and 20A. We could do 90 current and 10B, or we could do 80 current and 20B. All right, those are our choices. On the exam, I probably won't give you this problem because there's too many calculations. However, I do have an evil intent that if I do make you have to do this value at risk 4 times, maybe you'll remember the formula. So I do have that aspect to it, but return's pretty straightforward, right? Return's going to be 0.9 times 0.06 plus 0.1 times 0.06. Y'all see that? Current is 6. We know that's going to be 6%. That's really straightforward. No issue there. Then we get the expected, anybody remember the formula for expected risk? We just did it. I just said it like 20 minutes ago.
The weight of A.
So what's A? 90%, right?
times the 6% of the risk
The risk of A,
plus the weight of B times the risk.
what's the way to B here? Well, not, well, B is A, it's getting confusing.
Okay.
Right, so the weight of the current, 90% squared. The risk of the current, 6% squared, plus the weight of strategy A. What's the weight of strategy A? 10%. What's its risk? Only 0.5, right? That's going to help us. Anybody remember the rest of it?
Let's slow to
2.
times the weighted average.
Give me the numbers. 2 times
0.9 times 0.1 times 0.06 times 0.05 times the correlation.
what's the correlation?
1 or 0.4.
0.4, right. Raised to the 0.5. It should be lower than 6%. And it is, so that's good. You're not going to do this formula and get a number higher. It's not going to go up, all right? So that comes down, so that looks pretty good. We can copy that over. The return's the same. All we got to do is go through here and put the weights. And the risk is going to go even lower. Make sure I get them all. Did I get them all? That looks right, doesn't it? Oh, it goes even lower. That's pretty good. What's the VAR as a percent? So we take the expected return 6% minus 2.75 times 5.62. What is that in dollars? 95. What did the boss want? 70. It doesn't quite do it. What about 80%? Doesn't quite do it. Everybody staying up with me? All right. Then when we get to strategy B, the return is going to be real similar, 9% times 6, 90% times 6%, but strategy B has an expected return of 7%. So our return is going to go up. And if we put 80% in there, it goes up even more. So that's good. What about the risk? So we got 90% times squared times 6% squared, 10%. And here, what is the risk? A 9. That's got to hurt us. 2 times 0.9 times 0.1 times 0.06 times 0.05. 9 times what? Minus 0.25. What's that going to do to our risk? The risk is higher, but the correlation is negative, and lo and behold, it's lower than strategy A. And what is our bar? Our bar is 83. We'll do it one more time. We'll change our 9s to 8s. Should have set it up as a table, but just so y'all keep seeing this formula over and over again. I think I got them all. How does that look? Which of these looks the best to you? This one's pretty obvious, isn't it? The one with the highest return also has the lowest risk. That sounds phenomenal. What did your boss say that she wanted? Return the same or higher. They all meet that criteria. And a VAR below 70. So you're going to recommend that one. All right. Did I ever do this in practice? Yeah, I would get all these hedge funds. The tricky part is, do you believe these numbers? So, okay, you got a negative 0.25 correlation. I don't know if I believe that. Prove it to me. Show me an extreme year like 2008. How did you do? Show me a normal year. Show me a year like 2022 when inflation was an issue. Show me 2008 when it's the banking industry. Show me 2020 when you got a COVID, you got a pandemic. Show me when oil prices shot up. Show me all these different things. Is the correlation really negative 0.25, or is it negative 0.25 in these situations, but positive 0.6 in these situations? That's the kind of thing you're looking at. Ultimately, you have to kind of rely on them. Some of the hedge funds I looked at only had 2 or 3 years of data, but they had all this model data for the previous 20 years. Do you trust that? Do your theoretical models work as well in real life as they do on the computer? Who knows? I mean, they're using real life data and they're saying this is our strategy, but who knows if it would have actually come out like that. So I'm giving you these numbers. You somewhat have to trust these numbers that they're correct, but if they are correct, this is the best strategy. And there might actually even be a strategy that's even better. So if we take this times that, this time that, there's our risk. I mean, our return. Is there a better solution than 80-20? What about 70%? How does that look? Would you rather have 70 than 80? What about 60%? That looks pretty good too, doesn't it? What about 50%? Nope, now you're going back up, right? 0.7. Sorry, it's not helping me here. 0.7 looks pretty good. You got 58. 0.6, got 57. 0.5. Now the risk is starting to go back up again. What would be your ultimate level? We could run a solver and say, hey, give me the lowest risk possible. There's different ways to do this, but 0.8, it's a good answer. Why wouldn't we go to 0.6? 0.6 looks like a far better answer, doesn't it? 60%, 40. Well, at USA, first of all, we said we don't trust these numbers perfectly. And I don't want to have 40% in one hedge fund. So we wouldn't put more than 10% in a single hedge fund because it's just, you don't trust these. So that 20%, you're kind of getting on the edge of how much you can have in one hedge fund because these hedge funds, who knows if you trust the numbers. So you might know, yeah, there is a better answer. 60-40 is better than 80-20, but we can't put more than 20% in any hedge fund, so you're going to stop there. But you would do the analysis, but I would be questioning them here. So show me returns in this market, in this market, in this market. I want to understand how you do in different simulations, different areas. What happens when interest rates shoot up? What happens when they fall? What happens when inflation's higher? What happens when oil prices do these kind of things? I want to know all those different scenarios. But this is the analysis you would actually do. There's nothing fake about the analysis. What's questionable is do you trust the assumptions? If you 100% trust the assumptions, the analysis is pretty simple, isn't it? You're just plugging numbers into formulas, so it's pretty straightforward. Right? So which allocation would you recommend? And don't forget, and why? I would recommend 20% in B. Why? It has a higher expected return, and I get my VAR below 70 million. How do you answer the why? You answer the why by going back and seeing what your boss said that they wanted. All right, my recommendation, this is a high, in your first job, you have one job. And if you go into your first job thinking this, you will be very successful. This may not be true your second and third and fourth job, but in your first job, you have one thing. In your first job, you want to make your boss look like a genius. That is your goal. All right. You don't want your first job, your boss thinking you're trying to take their job. You want to focus on how can I make my boss a genius? If you do that, you will succeed extremely well. All right. And your boss sees that, they become your champion. Your second and third job, that's when you start taking your boss out. But in your first job, make your boss look like a genius, give yourself a chance, trust that they know what they're doing. So that's what we're going to do here. Your boss said this is what they want. Don't go, I don't think you really want that. No, it's, go give them what they desire. So express the why in terms of how it was expressed to you, what your boss wanted. And then I'm going to ask you to graph it. So how do you graph it? So actuaries in the room, be careful because finance does it backwards. I don't know if there's actuaries in here or not, but actuaries like to put risk on the Y and return on the X, but we do it differently. So we put return up here and risk down here. So as you go northeast, you're getting higher return, higher risk. As you go southwest, you're getting lower return, lower risk. Here's our current portfolio, 10.5% VAR at 6%. Here's your two A's, 10% in A, 20% in A. Here's 10% in B, and here's 20% in B. If I were you, I would draw a line in here because your boss said they wanted the VAR below 7%, right? 70 million. And I would draw a line here. They want to return 6% or higher. So essentially, there's your range that your boss is looking for. And 20% B is the only one that's in that quadrant of risk below 7%, return 6% or higher. We do a lot of graphs like this. You don't have to use standard deviation. Standard deviation probably doesn't make sense here. I would probably do VAR in dollars on that axis, the x-axis, because that's the way the boss expressed it. I've done on the y-axis, I've done expected net worth in 10 years. And on the x-axis, I've done probability of running out of money in 10 years. So I have how much net worth do you expect in 10 years? What's your probability of not having anything? And I would even show it like I did one where I said, why do we put 100% of our money in the emerging market stocks? Man, your ending net worth looks wonderful, but your probability of running out of money is really, really high. So it's a really, really great return, but wow, tremendous risk. So you can kind of demonstrate that. You generally want higher to be better. You generally want west to be better. So you really want to go northwest as much as you can. The efficient frontier doesn't do that, right? The efficient frontier goes like this. So is there an efficient frontier here? There is, but we can't draw it. What are we missing to do an efficient frontier with current A and B? We're missing one really key piece of information. I can do current in A, I can current in B. What am I missing to draw an efficient frontier with these three things? Missing one little piece of data. What's the correlation between strategy A and strategy B? I would need that, right? If I had that, I could draw an entire efficient frontier. What would dominate the efficient frontier? Strategy B. You would probably assume A and B are probably lowly correlated or even negatively correlated, but I need that. If I gave you all that, now this is the thing, if we could do this exam on Excel, I would give you much more and have you build it from scratch because I think you should be able to do that. But I can't do that here because I don't have the correlation between A and B. So my only choices are current in A or current in B. I can't do anything with A and B because I don't have the correlation between those. And you can't back into it with this data. You can kind of guess maybe what it is, but you'd be surprised that may not actually work. You can get some really, really bizarre answers. Right, so this is an actual exam question. It's a lot of calculations. And then I throw in, so 100% of y'all should get A and B right, all right, on the final exam. We're talking May here, so we're quite a ways off. And then I throw in a question C, which is the curveball, all right? So I can throw in one curveball, and this is just to see if you're really, really understanding it. So the manager of strategy B believes parametric VAR. So what is parametric VAR? It's this thing right here. Mean minus standard deviation, mean minus number of standard deviations times the standard deviation. That's parametric VAR. All right, you're just using the normal curve, you're using standard deviation and the mean, that's parametric VAR. So this manager is upset, even though he's getting the business, he's upset because he thinks parametric VAR overstates his risk given the positively skewed nature of his option strategy. I'm going to actually show you that later. The option strategies have high standard deviations, but you cut the tail off so they don't have downside risks. So standard deviation doesn't measure because standard deviation assumes symmetry. But if you cut the tail off, you don't have symmetry. You cut off all the downside. So he's saying, hey, we got an option strategy. So if you use parametric VAR, you're overstating my risk because I don't have that downside risk. So he runs a stochastic model. What's a stochastic model? That's when, like Monte Carlo, he runs simulations. And that's going to capture those option strategies because you have a big loss scenario. The option can say, no, you didn't lose that much. So here's his information on the option strategies. And which scenario are we interested in? So let's look at this. You're probably not going to, this one's not going to sink in. But let's look at it anyway. So what was their risk tolerance? Their risk tolerance was 0.003, right? They ran 10,000 simulations. Which of these simulations is the 0.003 probability? Those in my property casualty class, you remember? I won't call on you, but you remember what we did? Number of simulations minus number of simulations times the risk tolerance. You remember the rest of it? Who's in my PNC class? Becomes +1, right? So here, how many simulations we have? 10,000 minus 10,000 times 0.03. Why +1? Because we have to count number 10,000. So our simulation, oops, our value risk is simulation 9971. All right, 9971. What was his VAR by himself? So his mean was 7%. Number of standard deviations 2.75. His risk was 0.09. That gives you a VAR of 17.75%. What did the simulations give you? Gave you a VAR of 14.7%. Does he have a case that parametric overstates his risk? Parametric gave him a VAR of 17.75%. Stochastic gave him a VAR of 14.7%. Sounds like not only should we hire them, but they're even better than the numbers show here. Their downside risk is not as great. All right. We'll practice these more, but it's really a matter of sitting down and see what data do you have. This is only on his portfolio. So you use just the data from his portfolio, which is the 7%, the 9%, and you don't even need the 0.25 because you're only doing his portfolio. All right, so these are the kind of questions you'll see on the second exam. We'll practice them more and more and more, get some practice. Let me show you, well, let me look at the answer. The data supports his point. A stochastic VAR of 14.7% is much lower than a parametric VAR of 17.75%, probably because the parametric VAR assumes what? A symmetrical distribution. But with an option strategy, option strategies have positive skewing because you cut down that negative side. And I'll show you some option strategies that definitely fall into that category. All right, so this one won't sink in. You have to practice more and more and more to get used to it. However, you want to get to the point where you see a problem like this, you can just real quickly off the top of your head work it. You know what to do with correlation. You know the parametric VAR analysis. Can you do stochastic modeling in Excel? You can. So we'll see when we do. I'll show you all my March Madness that I've set up. I picked my first round using Monte Carlo simulation. It's based on historical. How often does the number one seed lose to the 16? Has that ever happened? How many times does the one seed lose to the 16 seed? Doesn't happen very often, does it? How often does an 8 seed lose to the 9 seed? It's over 50% of the time. So I put all that into my model. I run a Monte Carlo simulation and I get my picks. How accurate is it? Is as accurate as all of my friends on Facebook, with the one exception that it calls more Cinderellas than they do. It does a much better job of calling the Cinderellas. Why? Because my model has a 92% chance a 14 seed beats a 3 seed. I mean, a 3 seed beats a 14 seed. They're essentially assuming 0%. So I get a few more Cinderellas than they do. We had a competition at USAA. It's like, name your Cinderella team. And someone there, they picked like a number 2 seed. And it's like, I don't think you know what a Cinderella means. So I'll show you that. So you can, if you have good statistics, it's really tough to use Excel with correlations. That gets a little tougher, but you can run some simulations. The best models out there that I wish UTS had, but is At Risk, which I think got bought out by somebody. I don't know who that company is. I don't know what it costs. One of these I think Microsoft has, but I don't know the price. Somewhere in here has it. Buy now, maybe it would tell me. Well, it takes forever. Um, there we got it for students. That means it's cheap, right? Or not? Um, $130 a year. It's not terrible. I don't know what these other prices are. Yeah, total 380. I don't know what all you're buying there, but 380. Should UTSA provide At Risk? They should. I think at one point they did. What's the other one? No telling what will come up here. Crystal Ball simulation. This might be the one Microsoft owns. No, Oracle owns this. Crystal Ball, probably more expensive if Oracle owns it. They're very easy to use. You can set up your correlation table. You can run all kinds of statistics and all kinds of models. At USAA, we bought one from a vendor to build it just for us. And oh man, I loved it. And just immediately I got a project for it and I was so excited. The tax department came to me with a project and I said, the only way I can build this is using stochastic modeling. It was a product offered by AIG and they wanted us to buy it and it was tax driven. It was really interesting. The only way I could really figure it out. Sometimes the math is just so complicated, simulation is about the only way to do it. To really set up a true formula that's going to give you the optimal answer. And so these are really, really good products. UTSA should offer you one of these products. Do y'all use anything like this in any of your classes, like your stats class or your actuaries? Y'all do anything like that? So actuaries do a lot of stochastic analysis. So using this kind of stuff is really, really cool. I mean, it was the product we used saved USA probably $2 billion in 2008. I mean, it was that valuable because we discovered some things that that's one reason our pension plan was to use this analysis that I just showed. Man, we have this massive risk sitting out there no one's talking about. We need to hedge this interest rate risk. So it's pretty powerful. It was expensive. It was a few $100,000 the one we bought because we had a whole army of analysts behind us to help us with it. But it was pretty cool. So I wish UTSA would offer you something like this. I don't know if there are some cheap simulation models, add in Excel. There's probably someone out there selling something like that. Seek an affordable simulation. They should just say for college students, add-ins for Excel, several options are available. Read more. Sim tools, Spry simulations, SimVoy, Risk Amp, Simulation, Model Risk. So I don't know if any of those are good. You know, 6 of y'all get together, throw in $10, you could probably get one of these. I don't know how. This one's the top one, so that's a free add-in for Excel. That sounds pretty inexpensive. But the question is, can you bring in the correlation table? Because you can do Monte Carlo in Excel pretty easily, just using your random number generator. You don't need this. So the key is, do you get that correlation table? And so you have to read through them and see. Yeah, so, and optimization is actually pretty important as well, because you don't want to run simulations. You also want to tell it, hey, I have these 10 asset classes. Which one gives me what combination of these assets gives me the best return for this risk? So you need the simulation. You actually are going to do optimization using Solver, but it's not simulation. It's actually just finding the efficient frontier. You're not running simulations. So, all right. So let's go back to the class. Well, let's look at another problem just so you can see how similar they are. Because the problems, once you see two or three of them, they get very, very similar. Your firm has been running an absolute return fund. That doesn't, you don't need to know what that is. What is an absolute return fund? So absolute return, what they're trying to do, usually they're trying to never lose money, and they're trying to give you T-bill rates plus a spread. So they might say, I'm going to give you T-bill rates plus 4%, and we never lose money. Sounds really, really good. I think PIMCO has one. If I could spell it. I always wanted to work for PIMCO. PSPTX. Remember that? PSPTX. I won't remember it. What did I say? PSPTX. Does it look like it ever lost money? That looks like a loss to me. But absolute return funds, they're trying to give you kind of a T-bill plus a spread. That seems to be their biggest one. They have not done that well historically, but the theory sounds really, really good. Especially if you're worried about inflation, you're worried about losing money, getting T-bills plus the spread sounds pretty good. But they're really, really tough to do. I love PIMCO, great company. Would have loved to have worked there. So an absolute, but you don't need to know that for this problem because I'm just throwing out terms. They want to add strategies over time. Those opportunities arise. You have been asked to find a strategy to add to the fund. You're going to allocate 20% to it. Saying 80% in the current sounds a lot similar to the last one. It's a $100 million portfolio instead of a $1 billion portfolio. The risk tolerance is 0.2 instead of 0.3. They want to get the VAR below 7 instead of 70 million without harming expected return. It's almost the same problem again, right? So A and B, you're going to get those down pretty easily. You just got to make sure you can put that long formula on the exam and not have a lot of math errors. Just looking at it, which one looks best, A, B, or C? A is going to help you return. You can kick out B. Why? Because you know B is going to hurt your return. It has a 5.4% return, so you can already kind of kick that one out. C has a lower return than A and higher risk. So C by itself looks pretty inferior, doesn't it? Lower return than A, higher risk than A, but that negative 0.1 correlation gets interesting. Is that enough to help you? And that negative correlation, the higher risk actually can be a benefit to you. But wouldn't you really love to have the higher return? But what did your boss tell you? VAR below 7. So that's probably going to be the limiting factor. So A, you might talk to your boss and say, you know, A, I think is a little bit better, but I can't get the VAR below 7. That may be the issue. But if they say they want the VAR below 7, then that's what you're going to go to. So you bring these numbers in and you would calculate the expected return, calculate the VAR percent, calculate the VAR in dollars. combine them using that long formula, and you come up with your recommendation. Here's the current strategy. There's that strategy B with the lower return. Here's strategy A. It's going to really help you return, but what does it do to your risk? Only reduces it a little bit. So there's strategy C. But did you know that going in? Can you look at this table and say, oh, street C is obviously the best strategy? If you're only buying one of these four things, which one would you buy? I'd buy A, right? Our current, maybe B, but C is the one you would kick out. So you see how important correlation is. When it's a standalone, it may be the worst strategy. In combination with the rest of the portfolio, it might be the best strategy. So it's your answer can change dramatically because of that correlation assumption. And then they ask this question, your impressions as to any concerns about consistency between parametric and stochastic VAR from the data you have accumulated. This is simulations on the current strategy only. So you calculate the VAR of your current strategy. Your correlation is, your risk tolerance is 0.2. Which strategy are you looking at? If your risk tolerance is 0.2, how many simulations did they do? 10,000 again. Anybody remember the formula? 10,000 minus 10,000. 0.002 plus 1. So we're looking for simulation 9981. 9981, there it is. 10,970. I don't know what their actual buy at risk is. So what is the advantage of stochastic analysis? Well, you know the disadvantage of parametric analysis is you're stuck with that normal curve and with symmetry on both sides. So stochastic analysis, you don't have that. You can have it. You can say, hey, if you hit this number, do this. If this happens, do that. Especially with option strategy. You say your option strategy, hey, if it falls this much, I don't have any loss beyond that. So here it might be the other way around where it has more risk in stochastic because some simulations have fatter tails, and if they have fatter tails, the downside looks worse than what parametric gives you. You don't know what I'm going to give you on this last question. I'm running out of creativity on these as well, so they're going to start looking kind of similar. But there's a question. You get the normal table. So we'll practice these and practice these. This is very similar what happens in practice. So I remember once I was using I actually spoke at a conference, and we're doing enhanced indexing. What enhanced indexing is they try to give you the S&P 500 plus 0.25%. That's their goal. They don't want to kill the market. They want to give you the S&P 500 plus 0.25% in a year. So you beat the market by a little. And what I did is I took the alphas. What's the alphas? It's their actual return minus the S&P. Multiple managers, and got their correlations. And what I said in the conference is, man, if you find 6 or 7 of these managers and they're not related, you put them all together, you're essentially going to get this alpha with no risk. You can have this perfect portfolio that's always going to beat the market no matter what, without any risk of underperforming the market. And the audience knew what I was saying. They were kind of laughing at me because they knew, yeah, that doesn't really exist. But that was the implication. All these managers doing different things. They're all trying to closely mirror the S&P 500. They're taking just a little bit of risk so they can add more return. Sometimes they underperform, but on average they outperform. But if I put a bunch of them together, I end up with an S&P plus 0.25% without any noise. It just looks perfect. Do you really believe that? And they could tell with me doing the presentation. Now, who asked me to do the presentation? It was my enhanced indexing manager. He wasn't too happy that I was like, yeah, you guys are selling us some snake oil. But anyway, that was the nature of it. So you always, when you have these type of scenarios, you're talking to a hedge fund, you're looking at different strategies, you want to have some skepticism of the assumptions, especially when they seem too good to be true. Where did you get that number? Look at it. And the best thing to do is look at things in different time periods, different 5-year periods, if they have the data. If they only have data for 3 years. Now, next Tuesday, my security analysis class, Ricardo's going to come speak to us. He started this hedge fund a couple of months ago. Be interesting to see what he thinks his numbers are versus what his experience is. I gave him some of my money, so I'm kind of interested myself to see how he's doing. I didn't give him as much as they wanted me to because he's only has 1 month of data. He's a really smart guy, but I'm going to kind of wait it out and see. But you're always skeptical of his assumptions. He's had a great start. Does that mean he's good? There's people go to Vegas and do really well their first try. Does that mean they're good? You know, there's the luck aspect of it. All right, so we'll practice this more and more and more, get a little more. Thursday, we'll spend more time getting ready for the exam, though. The exam guide is out there. Exam 1 guide is out there. We'll work a balanced immunization problem tonight fairly quickly, just to remind you how it works, but you'll have this one as another one on the video to be able to practice. This looks exactly like what we did in class. There's no tricks there. And then we got some VAR problems. We'll work a few of those. Those should be pretty simple ones. There's several examples of those out on Canvas as well. And then we're going to do the essay in class, and you will be given the rubric. So we'll walk through the rubric and make sure you're comfortable with what's in each piece. So you have to handwrite it. You're not gonna be able to type. So if you haven't written in a while, be ready. Do y'all write in some exams anymore? It's kind of gotten pretty rare, but with AI and the fact that this exam's out there, it would be really hard for me to be able to monitor that. Plus, I mean, the ideal would be you sit down and you speak it to me one-on-one. That's I call that conversational intelligence. That's the best that you can actually off the top of your head just speak it. If you can do that, you know you've got it. So, all right, so let's look through that. That is the exam. So you've got 3 questions. I haven't got the points down yet, so don't worry about the points yet. It's got to add up to 75 minutes. I think it probably does. I just don't have the points on this one, but it will add up to 75 minutes. So the first question will be 40 minutes, second question will be 15 minutes, and then I guess 20 on the essay. And then, so the first question is worth 40 divided by 75. And so why do I do that? That's the way the CFA exam is done. The CFA exam is in minutes. All right.
Stop this office and be like, okay, turn in part 1.
No.
Okay.
No, I don't think there's a class after this, so you can go until you need to within reason. I had one student go to like 2 a.m. and then turn in an almost completely blank exam. It's like, yeah, thanks for wasting my time. I have a life too. You probably don't believe it, but I do sleep, I do eat. But yeah, someone who knew they were going to fail the exam and sat there till 2 a.m., maybe just to get back at me. I don't know. That was pretty irritating. So I do have students just sit and stare out into space for the longest time. It's like, I don't know what they're doing. The math question, I do think students, I'd like to talk to students really bomb the math question because I think the issue, I don't think it's intelligence. All of you are smart enough to do this problem. The math is not hard on this problem. I think it's the way students prepare for exams now. I think it's just students prepare for every exam as if it's a multiple choice. There are no multiple choice questions on this exam. There's nothing to help you. You just got to sit down and do the math. You have several problems to practice with. So I don't see if a finance student can't do this, then finance is probably going to be a tough career because a lot of finance, you don't do a lot of looking stuff up in finance. You do it off the top of your head. So you should just know this stuff. But the math here is this is really simple math. This is 8th grade, 7th grade math. So the math isn't difficult. You don't have to memorize any formulas because all the formulas are ones you should know anyway. It's like, should I memorize my name? Do I have to put that on an exam? No, I mean, there's certain stuff you just know, right? So it's kind of crazy to even ask, should I memorize it? You just know it. You're a finance professional. So you got to do that balance sheet minimization question, which I do break it up into questions. So we'll actually work at a problem at night, do the VAR questions and then the essays. So here is the exam from 2 years ago. So if you want to write some of these numbers down, we do the calculations pretty quickly. But before we do that, someone give me the first formula you need. Off the top of your head, don't look for it.
Duration of assets.
All right. Do we need any parentheses anywhere?
Yeah.
That whole thing? And then what?
Times the duration. Leverage, so here, we'll assets divided by.
The times what?
The leverage, but it's assets divided.
Okay.
By network.
Thought I heard you say duration, but okay. My hearing's not too good, right? Your leverage assets. All right. And then what formula do you need here? Calculate the expected net worth if interest rates were to fall. So you got the percentage change in net worth. What does that equal? This formula every finance major knows. Everybody remember that one? Minus
Duration.
change in yields and rates. All right. So that's the formula. Every finance major knows that one. You can then take net worth times 1 plus the change. That's going to give you ending net worth. Don't forget to do that. I'm not asking you what's the percentage change in net worth. I'm asking you what is net worth. So you got to calculate the percentage change. And then once you calculate that, take that. If it's a negative number, you'll be doing 1 minus that. But you take whatever percentage change you get, add that to 1 and multiply by your net worth, you get your ending net worth. All right. So there's 2 formulas you need. Not any complicated math there. Then a short essay question. Very, very straightforward. Dollar duration gap, and remember that formula? It's probably the simplest formula of all, which is probably why you don't remember it, because it seems too straightforward. So you're going to do the dollar in assets times what? Duration of assets minus the dollar in liabilities. That's a duration liability. That's your dollar duration. Yeah. Does that come back to you? That sound familiar? It's pretty straightforward. That number divided by whatever the duration is of your swap is going to tell you what? What are we looking for here? The notional amount. The notional is going to equal the dollar duration divided by the available duration. So here the duration is 6 years, so divided by 6. And that is all of the math you need on that first question. 40 minutes out of 75, 3, pretty simple. You could have done this in 7th grade, maybe even in 6th grade. It's not advanced math. All right. You do have to do one extra calculation here, and that is get the duration of assets. But the duration of cash is 0, so it's pretty straightforward. 80% of their loans have a 3-year duration. So 0.8 times 3 is going to equal 2.4 years for your duration of assets. Everybody good with that? Got 80% in loans with 3-year duration. So the duration of their assets is 2.4 years. So the duration of net worth is going to equal 2.4 minus 900. divided by 1,000 times 4 times 1,000 divided by 100. Anybody disagree with that? I think I downloaded the answer key. Doesn't look like I downloaded the answer key, but I do have the answer key just in case. So the duration of f is 4.4. I mean 2.4, so 2.4 minus 0.9 times 4 times 10 gives you minus 12. See if y'all get minus 12. You have to be hitting calculators. You have your calculators. You have to use a calculator on exam. I realize you'll never use a calculator again after you graduate, but on the exam you have to. I would prefer you use Excel, but make sure you can use a calculator. If we can get one person to confirm that looks right, let me know. That's right. All right. Now, in this question, I'm real picky. I do minus parentheses duration times parentheses change in yield because you got all these negative numbers and all that. So I'm going to say equal minus parentheses minus 12 times parentheses. Interest rates are falling. How much is 200 basis points? 0.2%, 0.02, right? You take 200 divided by 10,000 equals 0.02. So basis points is 1/10,000th. So what does that equal? Minus 12, that's positive 12 times minus 2. So this is the firm that actually gets hurt if rates fall. So they would fall by 0.24. Does that sound right? Pretty unusual for a bank to fail if interest rates fall, but this bank was betting on rates rising and they didn't, actually fell. This might have been a good strategy in 2020 when interest rates are like at 0. It's like, why not go for the fences? All right, anybody disagree with that? Then we got to do this. We're going to say our net worth is at 100. So 100 times 1 plus minus 0.24 equals probably 76, I would guess. Yeah, 76. I have students that let this question mess them up for the next question, but there's no relationship to it. All I'm really doing here is making sure you know this formula because it's such a critical one. I'm worried some of y'all are going to graduate and never seen that formula, and it's like one of those formulas like we just all know really, really well. I think we underserve fixed income in college. And bonds are bigger than stock markets. There's a lot more dollars in bonds than stocks, so it'd be nice to know. All right, any question on that one? All right, now the next one, a lot of students miss, but I don't understand exactly why. This is the same formula up above, except for what the board is saying is if you use this formula, the result better not be if it's 200 basis points, the result may not be worse than negative 12%. If it's 100 basis point, not worse than -6. Here, the one we tested was -200. The board said -200, the worst you can be is -12. What do we actually have? -24. Did we pass? We failed. All right, so they failed. If you want to, you can put the actual here just to show, hey, here they're okay, it's plus 24%. Here they're okay, it's plus 12%. Here they fail, they lose 12%. Here they fail, they lose 24%. If you want to do that, you should be able to do it in your head because it's pretty straightforward. Your duration's -12. So minus 12, that's +2, positive 12%, positive 12% times 0.02 gives you positive 24%. So they fail these two. They fail when rates fall. Duration, net worth is what? Too high or too low? Too low. Board allows, but too low, you might say too low at -12 years. Board allows duration of net worth to be between what? Just looking at these numbers, what is the board saying is okay? What's the highest it can be? If the duration is 7, what would you get? You get 14%, 7%, -7%, -14%. Does that match? If your duration was 5 years, would that be all right? 10%, 5%, 10%, 5%, 10%, that'd be more than accept. What's the number that would work? What's the max it could be? So say that out loud. Not 6%, but 6 years. And it's not just 6, but it's -6 years, the +6 years. All right. You should get used to it. You can really just look at whatever's at the 100, that without the percentage sign is the highest or lowest their duration net worth can be. Huh?
Was it always, whenever it's -100 or +100, it doesn't?
Well, the board's saying we don't know if your duration net worth is positive or negative. It could be positive, it could be negative. If it's positive, when rates rise, you can't lose more than 6%. If it's negative, like this firm, if it's negative, if rates fall, it can't fall more than 6% or 12%. So the board, their policy say, we don't know if your duration net worth is positive or negative, but if it's positive, here's your constraints. If it's negative, here's your constraints. But you know, looking at the 100, that tells you their duration net worth can be as high as +6 or as low as -6, all right? Questions on that? All right, so I'm answering C and D together here. The firm or the bank needs to do what? Your duration is too low. What do you need to do with the duration of assets? Increase them or decrease them? This number gives you a number that's too low. Does duration assets need to be increased or decreased? Increase. They need to increase duration of assets, or what do you do with duration liabilities? Decrease duration liabilities. So if it's too low, you've got to increase duration of assets, reduce duration liabilities. Be careful on an exam that you don't say they need to increase assets or decrease liabilities. It's not increase assets, liabilities. It's increase the duration of, right? I should probably spell it out. There's a little bit more in the notes that you can get to get full credit. You can talk about. We talked about, having longer term auto loans, maybe cutting back on credit cards, those things that mess up operations, or they can have certificate deposits that are shorter term, not go out so long. There's things they can do. They can mess with their debt. But the simplest would be what? Interest rate swap that goes from, so we're focused on the liability side. We want the liability duration to be shorter. To be shorter, do you start with fixed and end up with floating, or start with floating and end up with fixed? Which one's going to reduce the duration of liabilities? Start with fixed, go to floating. Start with floating, go to fixed.
Fix the fund.
Fixed to floating. You write that here, then when you get to the second question, you're not going to be confused when you get that question asked, what should they do? Which side should it be on? You're going to look for the ones that started off with fixed rate debt and ended up with floating rate debt at the end. In that case, that's almost always going to be AAA, because AAA has the comparative advantage in fixed, so they'll start with fixed and with floating. But I mean, look at the question and make sure. All right, so that's B and C. All right, so there's question one. The next question is the swap question. First thing you do is what? Write the word difference. So what's the difference here? 280. The difference here, 50. If you want to think in advance, that's 230. Half of 230 is 115. You kind of know the answer, but remember, in real life, that's not the way it works. I know some professors teach it that way. The swaps curve doesn't know your individual debt. It's using the average debt of all corporate bonds. So it's not going to be perfect for your company. Your company's debt might be treasuries plus 15 or treasuries 25. But on exam, I do it like that because it's easier for me to set up the problem and make sure it works. So the answer to the A is almost always the same answer because of the credit, the term structure of credit spreads. But who has the comparative advantage in fixed income, fixed rate debt? So all you got to do is see where the number is bigger. Wherever the number is bigger, that's for AAA has the advantage. Where's the number bigger? Almost always going to be on fixed rate. Wherever the number is smaller, that's for BBB has the advantage. This is asking who has the advantage on fixed rate. AAA has the comparative advantage in fixed rate. Now it has an absolute advantage in both. It's cheaper in both, but it has a comparative advantage on fixed rate. BBB actually has a comparative advantage on floating rate. Even though they pay more, it's a smaller difference than what they pay on fixed rates. So that's the comparative advantage. Right, then we do the swap. Well, you're going to do the swap. If you look at the question, it tells you they're going to borrow where they have the comparative advantage. So we already know that for AAA, they're going to borrow fixed rate, T plus 20, and BBB is going to borrow floating rate. It's SOFR plus 60. We already know that because they're going to be in their competitive advantage. And then we do the swap. All right. Swap, you just write it down. And I'm real picky on this as well because of plus and minus signs. AAA is going to receive, and we're talking about the cost. So if they receive, that's going to reduce their cost, minus T. And watch this, they're also going to receive 125. So minus 125. That means BBB is going to pay treasuries and they're going to pay 125. So what they pay is a plus sign because that's going to increase their cost. What they receive is a minus sign. And AAA is obviously going to pay SOFR and BBB is going to receive SOFR. So receive, you'll see I'm doing a negative sign for receive and a positive sign because we're talking about the cost. So you do this, the T's cancel out. So you end up with plus S minus 105. What were they before? S plus 10. What did we say half of this difference was? 115. What's 10 minus 115? Minus 105. What do we get here? Plus S minus 105. Here, the S's cancel out, so we get plus T plus 185. What was it before? T plus 300. 300 minus 15 is what? 185, right? So half of the difference of the difference is the way I set up the problem to share between the two, but don't put it in your mind that that's how it works in practice. It's just a simplification that we do. And that's what the question's asking. What's their ultimate borrowing costs? So answer the question that's there, their ultimate borrowing costs. So AAA, they may want floating rate debt, but if they do floating rate debt, they're going to play SOFR plus 10. So they really want floating rate debt, but they have a huge advantage borrowing fixed rate. So what did they do? They borrow fixed rate, and they get a much, much better floating rate charge by doing the swap than they would have if they'd done it themselves. Triple B might prefer the borrow floating rate because that's where they have comparative advantage because they're riskier than AAA. Borrowing longer term is kind of a pain. So what do they do? They borrow floating rate, they use a swap, and they reduce their cost of debt quite significantly. All right. Any questions on that one? I do have students that leave that blank. If you end up with 2T minus 105, you probably started wrong. You're going to end up with 1S at the end or 1T at the end. And you're probably going to end up with 1S for AAA and 1T for BBB because of the term structure or credit spreads. I have done problems in the past where I didn't do that, but it's so bizarre not to have AAA have the advantage in the fixed rate just because they're higher quality that I'd rather stick with what real life is. All right, so in this last question, we said we want the swap that they started off in fixed, ended up in floating. Who is that in this question? AAA started at fixed, end up in floating. So the way I would answer this question, AAA as they started in fixed rate and swapped into floating rate, thus reducing duration of liabilities and increasing duration net worth. And this is an important question to get the word duration of in. I do get students saying reduce liabilities, increase net worth, but that's not what we're doing. We're reducing the duration of liabilities, increasing the duration of net worth. That would be a full answer there. So this is a good time to announce March 4th, after our exam, at 4:30, the Chief Investment Officer of USAA, the new guy's Seth Vance. I haven't met him yet. I'm going to talk to him tomorrow at 3. He's going to come speak. If you go to that, I'll give you an extra absence makeup. So instead of 3, you can get 4. But I want you to go and I'm going to warn him tomorrow. Y'all might ask him some tough questions. You could ask him, we've been studying balance sheet immunization for banks in our risk class. Does USAA follow balance sheet immunization? Do you do interest rate swaps? Do you do futures? How do you monitor that? Now, when I was there, they didn't, but I don't know if they do now. They did some swaps. My friend was kind of pushing to do some European swaps. So that'd be an interesting question. You might ask the question of how does the investment strategy differ between your life insurance company and your property and casualty insurance company? That would be an interesting question. You could ask about the credit risk that they're taking. Do you buy high yield bonds? On the life insurance side, they're desperate for spread. When I was there, our CEO said, you can buy all the high yield bonds you want to, up to 5%, as long as none of them ever default. We said, okay, good. That means we can never buy high yield bonds. Okay, yeah, that's good. We thought we could, and then we had one default, and he said, no, you're allowed to buy them, but they can never default. And we said, okay, that changes the equation, because if you buy high yield, you're going to have defaults. You could ask him about that. He also manages the pension plan. Any questions you could ask about the pension plan? I have no idea if they've kept my strategy. They may have gone back to 70% stocks. I have no earthly idea. He may think like the guy from AT&T that that's idiotic and going back to stocks. Who knows? Anybody have the guts to ask him that question? And are you more worried about offending him or offending me? I don't know. I don't mind. I'm old enough now that I don't really care. So, so feel free. I'll warn. Do I need to warn him that y'all might ask some tough questions? Anybody have the guts to ask those kind of questions? So we'll see. Anybody want to go next Wednesday? It's in 2.0106, that huge room. So yeah, if you show up, make sure you let me know that you're there, 4:30 to 5:30. I really want to talk to him because I was telling my P&C class, I've got some history of USA that I think he would find very interesting. I just did a podcast with the Investment Society going through one major thing we did at USA. Not to tell you that story at some time. One of my first biggest projects. And I think he'd be really interested. I think he'd be interested in what we did with the pension plan, what we did with the property casualty insurance portfolio, what we did with the life insurance portfolio. I was real lucky to be there during those years, and I think he would find it quite fascinating where USA came from. And it also gave them some sense of why they are where they are today as well. That might be interesting. And I don't know if he's gotten the USA's tax situation. It's a bizarre company. It's the only company I know that their after return on stocks is higher than their before return on stocks. That'd be pretty cool, right? You make more money after tax than before tax. It's kind of cool. I don't know if he's seen that yet. I don't think he's worked for reciprocal before. His background is really strong if you look at his bio. So anyway, you might ask them on the pension plan, do y'all use dollar duration gap analysis? Do you still use interest rate swaps? You can say still use, so you'd have some insight that he may not have because they got rid of the interest rate swaps after that big blow up where they made all that money. It was like, we don't need them anymore. You got more than enough cash now, but it'd be interesting. So you could ask him, I bet some questions no other college would ever ask him. So I've given you some inside scoops on USA that you would be like, why are y'all asking these questions? He'll probably know, but all right. So let's try this question. The dollar amount of assets was 1,000. The duration assets was 2.4. The dollar in liabilities was 900. The duration liabilities, I think, was 4. 2.4 for the assets, 4 for the liabilities. It looks like 1.2, but let me look. Don't trust me. I can't do math in my head when people are looking at me. So yeah, 1.2 billion. And remember, do it absolute value. Why? Because you've already talked, if it's a negative or positive number up here. You're going floating the fixed, a fixed to floating, that's what the negative, so you don't have to worry. You just need to give them the notional amount. You're not going to tell your broker, I need negative 1.2 billion. You just gonna need 1.2 billion. I'm going from fixed to floating. All right. So absolute value. Same thing we talk about with value at risk, right? You don't say value at risk is negative. We just know it's negative. Here, we don't need the negative or positive because that's what the swap is telling us. So how much do we need in the swap? 1.00 divided by 6 is going to be 200. And I assure you, this is not a textbook. This isn't made up. This is the exact calculation I was doing at USA. All I needed was the duration from our broker, and when he told me I have a 30-year zero coupon, said, well, that's easy. The duration's 30. I can do that in my head. So yeah, this is exactly what I need. Really easy conversation. Any questions on this one? Most students do get this one right. Some have the wrong number somewhere in here. They miscalculated. As long as you use the correct wrong number, you'll get full credit. So if you got the 2.4 wrong somehow, as long as you're consistent bringing it down. Very important on the exams, show all your work, because if you get it wrong, you don't show your work, you miss everything. I can't give you partial credit if all I see is the final answer. All right, so show your work. All right, any questions on that one? If you plug this 200 in with the duration of 6 and put it back into this formula here, so you just add in an extra 200 on the liabilities, and you change the duration of the liabilities. You'd have to calculate it out. In this case, it actually would be -6, because you're going to fix the floating. But if you plug that in, you would end up with exactly 0. You might experiment with that sometime, but you would get exactly 0. All right. On this one, I won't give you the full answer, but I think I gave you one in a previous class, but it's not arbitrage. Because while we are eliminating one risk, interest rate risk, we are picking up another risk called what? Counterparty risk. A special case of credit risk. You can explain it more there. I'll give a few more words. If you want to explain what counterparty risk is, the fact how it's different in credit risk, the lender is always exposed to the borrower. But with this, sometimes you owe money, sometimes they owe money, so it can change. And if you want to bring in the definition of potential exposure, that wouldn't be bad to get a few extra bonus points. So there's extra words you can definitely put into that. But the bottom line, you'll get most of your credit if you say that. This will be the answer no matter what question I give you. So that answer won't change. That is the answer. Why did I put that question there? Because every finance major uses the word counterparty risk. This might be the first class you've ever heard it, but there's things when you interview for jobs, everybody just assumes you know, and then we don't teach it in college, and they're like, there's one poor intern at USAA, this poor lady, she had never heard of FTE before, and her boss came to me and said, how could you recommend to hire her? She doesn't know what an FTE is. And I said, how many of y'all know what an FTE is? Yeah, she was like, I can't believe they didn't know that full-time equivalent. It's like, yeah, we don't use that in college. I mean, and she was just beating up this, not physically, but it was like the poor lady, she was like, man, she's such a nice person. Can you just like pretend like she's not, she's actually quite smart. She just had never heard that phrase before. So it really is good. You don't want to be in an interview and they talk about counterparty risk. And you're like, what in the world are you talking about? So counterparty risk really just comes up on derivatives more than anything else. There probably are a few other applications outside of derivatives, but it's a good term to know. All right. Any questions on this first one? What should the class average be on this first question? 100. What should the standard deviation be on this first question? Any guesses? What should it be? Should be 0. What do you think it will be? Do you think it will be 100 and 0? It should be, but it never has been before. Would I be upset if everybody in the class got 100 and no one was cheating? Would I be upset or happy? I would actually be ecstatically happy. Someone's going to say your exams are too easy. It's like, no, the students are too smart. I don't have any problem because I did this exactly like my previous classes and they ace it. So y'all be the first class. I probably would give you all $10,000 if you did that. I think I'm pretty safe, not have to worry about that. But I could do that and it wouldn't hurt me that much. So yeah, I probably could get away with that. All right. Then you get in these problems. What's the formula here? Real simple formula. Your value at risk equals what?
Your mean.
The absolute value of your mean. Then what? Times your number of standard deviations.
Then times your standard deviation.
Times your standard deviation. Yeah, you did this on stats. So I'm really just repeating what you did in your stats class. So in this class, this time you got absolute value as an expected return of 1% minus the number of standard deviations. What do you need for that? The risk tolerance. What are you going to look for in the table? Can you do that off the top of your head?
955.
Go a little bit further out. 0.95955 would be 4.5%. So it's less than 1%, so 1% would be 0.99. So this is 0.45%. So what would it be? So if you need to go on your calculator and do +1 minus 0.0045, and what are you going to get? 0.9955, right? 0.9955. Y'all see 9955 anywhere?
Six.
Right here. 2.61. So minus 2.61 times our standard deviation. Your standard deviation is 2%. So 0.01 minus 2.61 times 0.02, and you get 4.22%. Nope, you don't get 4.22%. Oh, this is a different, oh, I'm in the wrong problem. Okay, 4.22%. Like, oh no, I've got the wrong problem. 4.22%. Anybody can confirm that?
Yeah.
Okay, good. All right. But their budget's in percent, so that helps. They fail as the VAR 4.22% is greater than a budget of 4%. Pretty simple, very simple problem. Most students do get these right. Global macro fund. We may talk about global macro. That was my favorite hedge fund. We have a hedge fund manager who's going to talk to my security analysis class on Tuesday. If you desperately want to listen in, we might be able to squeeze 1 or 2 people in there, but that room's pretty small. I thought about getting the auditorium and inviting a lot of people. We might do that if we get a lot of interest. But if you really want to hear him, he's one of our stars from UTSA. I've probably talked to you about him before, but he started his own. He's not global macro. He's doing market neutral. But you don't need to know what that is to answer this question, but you probably should know what a global macro fund is. So you could look it up. We might talk about it later in the class. All right, the second one is a stock portfolio manager, pretty boring. So it's daily. The expected return is 0% with a 1.2 standard deviation. Their tolerance is 1.7%. So what are we looking for in the table? Any takers on that?
4090.
0.993, right? 0.983, excuse me, 0.983, is that right? There it is right there. 2.12, 2.12. So the VAR, and I do like to do, 0.01 or 1.7%, but I'm not going to do it here, but equals the absolute value of 0. Don't let the 0 throw you off because we're doing daily. Your best guess on a daily, it's going to be 0. Now you might ask, how in the world does this hedge fund make any money if the expected return is 1%? It's because it's an alpha manager. They put that on top of another portfolio. So if you have a $1 billion portfolio making 8%, you hire them and now your expected return is 9%. So we did that a lot. We'll talk about that. I don't know if you've ever heard of alpha beta separation. It's a pretty cool thing to look up with. Look up alpha beta separation. We may talk about that. It's a really, really cool idea. So their numbers are annual numbers. They expect to add 1% to your portfolio with a tracking of 2%. Here, though, this is a daily number. So any given day, zero is your best guess. If you're trying to guess what the S&P is going to do tomorrow at 0%, you probably wouldn't guess that because we have futures overnight that are telling us market's probably going to be down tomorrow. But if you didn't know, like next Wednesday, your best guess for next Wednesday is 0% on a daily basis. And our number of standard deviations is 212. And our standard deviation is 1.012. So minus 2.12 times 0.012 gives you 2.54%. And rounding's okay. But here the risk budget's in dollars. So the VAR in dollars, it's going to equal the portfolio, 550 million times 0.0254. You get 13.9, if you didn't fin, if you round it up, at 13.97. How did they do here? Their budget? Pass, cost, VAR, 13.97 is less budget of 15. Pretty straightforward question. Any questions on that? Right here we have a pension plan, $3 billion portfolio, has an expected return of 5%, standard deviation of 8%. What number in the table we're looking for? $985. So that is 2.17, 2.17. What did you notice about all of the table values? How many did you have to interpolate or use in between? You notice they were all exactly in the table. So I didn't throw any curveballs at you. So I tend to do that. And you would, if I were you, if I did throw one that was in between, I would just use the higher number, 2.18 or something, but I try to make them the same. All right, so this is the same question again, the value at risk going to equal the absolute value of here, 5%, that's the expected return, minus 2.17 times 0.08. So 0.5 minus 2.17 times 0.08 gives you a loss of 12 point, VAR 1236. Here are the risk budgets in dollars. So the VAR in dollars equals 300 million times 0.136. That gives you 30. I mistyped the number. That's 300. 37.08. Did I have it? Do I have it right? I'm sorry. It's a $3 billion portfolio. So I did have it. 3 billion and the budget's 300. So I did it backwards. All right. So 370.8. They failed because the bar of 370.8 is greater than the budget 300. Straightforward. So you've really had the same question 3 times. It's just plug in the numbers and go. Then you get whatever kind of crazy question I might ask. Bill Gates. Your boss has determined the portfolio gains 3% or more this year. The company will not be required to make a large contribution. They are considering moving to a portfolio strategy with an expected return of 6% and a standard deviation of 9%. They cannot afford to make a contribution this year. Which portfolio strategy has a higher probability of making 3% or more this year? All right. Our number of standard deviation doesn't change. The 2.17 doesn't change. Their risk tolerance is the same. When you're given a target, make that your VAR. Instead of saying VAR equals, instead say 0.03 equals, and then you do the same thing. Now here, the positive negatives are actually kind of important. So what we're asking is, how far is this 3%? Now it's below the mean. So our probability is going to be greater than 50%. Would you agree? If they're expecting 6%, they're asking if they need 3. It should be greater than that. So here, the positive or negative actually makes a difference. But on the previous question, our mean was 0.05 minus 2.17. I mean, minus number of, I messed that up. The number of simulation actually is what we're figuring out. Sorry. Your standard deviation is the same on this first question, which was 8%. All right, that's the first portfolio. The second one says 0.03 equals 0.06 minus number of standard deviations times 0.09. And what you're doing is figuring out the number of standard deviations and finding that in the table. So you've got 0.03 equals 0.05 minus the number times 0.08. Everybody agree with that? You take the 0.05 over, you got negative 0.02 equals minus number times 0.08. That gives you 0.02 divided by 0.8. It gives you 0.25. You go to the table and you find 0.25. You get 0.5987. I use the norms disk to get that. I cheated and use Excel. Now we could go in this in depth to make sure you know it, but this is the question to figure out how much you remember for your stats class, because every question can be different. If we go into depth in this, I'm just helping you with this problem, and you're not going to have this problem, all right? So you've got to be able to work it. Y'all kind of see how this works? You kind of have to let your mind kind of let it sink in. So on this one, the number of standard deviations, this kind of doing good. Algebra equals 0.25. And on this one, the same thing. Think the 06 over here. You got negative 06 equals negative 09. So you divide it out, you come up with 0.3333. That's that 0.3 divided by 0.09, 0.3333. You can't go out 0.3333. We can only got 3. So 0.33, the probability is 6293. Rob, see if Bill Gates knows how to spell it. Okay. 0.33 is 6293. And 0.25,
5987.
I'm sorry,
5987.
5987. So what they're expecting in practice, and what you got your stats class, anything related to normal curve, you should be able to do it in a nanosecond. You just got to somehow get used to it. So I throw these problems at you. Probably 80% of the students miss this question, which means you just need more practice. But the normal curve is something we use all the time in finance. I think Josh mentioned that last night in the investment society. We overuse it in finance because there's a lot of distributions that aren't normal. But that's the way we use it quite a bit in finance. All right. So what if you get everything right, but this last one, it's a 2-minute question. So it's 2.67. So everybody in class should make a 97 on this exam at a minimum, and then 80% should get 100. So 20% might miss this question, and then the rest will get it right. All right. So we should have a really high class average. But y'all remember this from your stats class? Doing stuff like this, all kinds of configurations you can do. If you're not really sure, draw the normal curve. You got 6% right there. You got 3% right there. So we're asking a probability not of making less than 3%, probably making 3% or higher. You can see it on the graph that it's going to be greater than 50%. If we're to say, what's the probability they'll make less than 3%, then you would take 1 minus that. It'd only be about 40% chance. All right. But here they're asking which one has the higher probability. And in this case, even though this one's riskier, it has a higher expected return. It's going to help you. This one kind of makes sense that this would have a higher probability. It has a higher expected return. The higher risk means you could lose more, but it actually helps you get that upper side. So, all right. That is the math part of the exam. No questions on that. Everybody's good. All right, now the blog. We can't go through this again because we did a whole class. Your best bet, if I were you, is to go back to when I talked through the PowerPoint. And as we get to each one of these, write them out and get them ready. You'll get this on the exam, but that's all you're going to get. So let's see how many y'all can do. The 4 groups of risks that are not, he really had 3, but I gave him 4. What were the 4? Just top real quick. Fear risk, career risk, asset risk, which is the bigger of those 3, 4? ALM is the biggest. Which one do we spend most time on? Career risk because of career risk. That's how we're compensated. That's career risk. So that takes care of this first one. You have to define them real quickly, but they're not that difficult to define. Peer risk is just your risk on underperforming the index or your peers. Career risk is that you get your client fires you. Asset risk is that your assets fall in value. ALM risk is that your assets and liability values don't move together and you lose net worth. That, in a nutshell, what those are. The biggest of those is the ALM risk. We spend most of our time on peer risk. Why? Because that's how we're incentivized. That's how our careers. There's a direct link. Now, if we linked incentives to ALM, then our career risk, we link to ALM risk, but our career risk is linked to peer risk, so that's why we focus in it. That last one, ALM risk, has 4 subcomponents. I remember those 4 subcomponents. Inflation is one of them. Interest rate risk.
The interest rate keep down.
So longevity risk, people living too long. And healthy people do what? Adverse selection or anti-selection. So those are the 4 you have those. Which is the one the dollar duration gap analysis addresses? Interest rate risk. Which one's the easiest one to manage? Interest rate risk. All right. These two right here are pretty important. If you understand that table we did with the $500 and all that. So I'll say it to you again. I bet a lot of you are not going to give me enough depth on this. Those longer term liabilities, because of the discounting process, they're way out there. So their present value is really small. It means they're a small percentage of the liability, but they're a big percentage of the what? The interest rate risk, right? When interest rate move, they move the most. So they're a small part of the liability, but they're a big part of the interest rate risk. And it's not symmetrical. When rates fall, they jump up a lot more than they fall when rates rise. That's the symmetrical side. You could actually do the math problem. Remember how you do it? You just take the present value of $500 over 30 years at 7%, 6%, 8%. You can show it. If you want to do the math, it's pretty easy to do. So if you want to be real fancy, what do you say about the liability? The liability has positive convexity. That's what kind of convexity is. It rises more when rates fall than it falls when rates rise. All right. Arnott suggests balancing 2 out of 3. I absolutely reject that. If one's the biggest and the most important one, I don't buy it. But what is he doing? He's being, politically correct here because he knows how the industry plays. But he says, I've got good news for you. You don't have to radically change what you're doing because those long liabilities are a small percentage of your liability. You can just take 10, 15% of your assets, put them out long duration, and you can eliminate a lot of that risk. All right. Be real clear on what his recommendation is. His recommendation is, hey, let's eliminate the biggest part of the interest rate risk, which is those long liabilities. Take 10, 15% of your portfolio, go really far out in duration. And how's the easiest way to get a lot of duration? Interest rate swaps, right? That's the fastest. He didn't talk about that in his article, but that is the easiest way. All right, any questions through the Arnott stuff? He didn't do the second one, that comes from me, and he didn't have the career risk, but essentially the Arnott article. All right. Then you get to the blog. So now you're getting into my view. My view is a little bit different than his. First of all, how do you increase the value of the firm? There's 2 ways to do it. Reduce the risk, the cost of capital, or increase, and how you increase value. Just free cash flows or do positive net present value projects. That's the way we increase free cash flow. You're adding positive net present value projects. All right. You learned that in 2013, way back there. What is adding a pension plan to your firm or borrowing money? What does that do to your WACC? In normal times, having more debt doesn't really impact your WACC because it increases your risk of your equity. So those two offset each other. But what do we say about a pension plan? It's extremely sensitive to interest rates and it's sensitive to inflation. A pension plan will probably increase the cost of capital of a firm because that's a pretty risky liability. It's not like normal debt. So that's pretty important there. We talked about that quite a bit. If you stick your portfolio in a pension plan in the stock market, what's the net present value of that? 0. So what's the value added of buying stocks? 0, because you're getting exactly the return to compensate you for the risk. In reality, what's really the net present value? It's probably negative because people are doing active management, paying fees. What if you put that portfolio into bonds? What's the net present value of that? 0 as well, right? You get the exact return. So are you increasing the value of your firm by sticking money into the stock market? No, you're getting exact return you should. There's no value. Are you harming your firm by putting it into bonds? The net present value is 0. So that's what I'm looking for there. That gets down to this one here. What is my recommendation? Completely hedge out all the interest rate risk, which means buy bonds that can hedge it out. The net present value of those bonds is 0, but what do you do to your WACC? You reduce it back down as if you didn't have that pension plan. Adding a pension plan makes you really risky. Your WACC shoots up, but if you hedge it by buying the bonds, you bring it back down. Buying the bonds doesn't hurt you. The present value of that is 0, so you essentially have brought that WACC back down. That's the most complicated part of the answer. I can't do it all again because we did it before. I also argue that that's your job. Your job managing a pension plan is to put the beneficiaries first. And how much benefit did the beneficiaries get if you buy stocks and the stock market shoots up? They get nothing. What happens to a beneficiary who buys stocks and the market crashes? They could be harmed. So can you be meeting your fiduciary responsibility by putting the pension plan in the stocks if the upside all goes to the corporation and the downside goes to the beneficiaries? That doesn't make sense. All right, so that's what I'm looking there. The plan sponsor, that's the corporation. Its responsibility is not to make the beneficiaries a top priority. What does it say? So obligated. They're the only thing you can look at. It has to be your entire focus. Wouldn't you love to hear AT&T explain how that they do that with putting so much in the stock market? Ask Seth Vance on Wednesday if they went back in the stock market. I mean, can you imagine the debate y'all could have? I'll just sit back and listen to see how good y'all do at arguing my side of the argument or arguing against my side of the argument. So my recommendation is hedge out all that risk, interest rate risk. It's in the best interest of the beneficiary. It's also, in my opinion, the best interest of the firm, because whether you do stocks or bonds, there's no added free cash flow. There's no positive net present value. But by doing the bonds, you reduce the cost of capital back down to as if they didn't have the pension plan. So the value of the firm goes up and you're doing fiduciary responsibility. I don't know if y'all remember what I said on the benchmark, but remember we went from like a 2-hour meeting where we're doing all this peer review and how do we do versus the index to just saying return on the assets, return on the liability. We matched. Any questions? It went from 2 hours to like 10 seconds. It's like really, really easy. So what I mean by benchmark, the benchmark for your assets is what? The return on your liabilities. If your liabilities are up 8%, what do you want your assets to be? Up around 8%, pretty close, right? If your benchmark's down 10%, your assets being down is not that big of a deal, as long as you're not down more than 10%. So my benchmark is no longer the S&P 500. It's no longer my peers out there. My benchmarks, what is my liability doing? What do my fiduciaries want me to do? The exact same thing. They want to make sure we have assets there to pay their pensions. And I've already talked about this one. I believe doing that not only protects the beneficiary, I actually think it increases the value of the firm. All right, that's the toughest part to put all this together. You have to let it sink in. I would love to do this question where you sit and speak it to me. You might try that prepping for the exam, to explain it to someone else. And I don't mean with the rubric, I mean without the rubric. That's where you really get going. Wouldn't you love this question come up in an interview and you have to explain why you believe that? So if you go to AT&T, don't bring it up then. But we'll see with Seth Vance on Wednesday if that's what he wants to hear or not. Seth will understand this because he has worked with life insurance companies before. What do life insurance companies do? Exactly this. They manage out all of that interest rate risk, and they do it incredibly precisely, far more precisely than pension plans do. So he should understand that concept because he's worked with life actuaries before. But does he believe it on a pension plan or not? That'd be interesting to see. You do have the blog, so if you didn't capture any of that, you can read the blog again. You can watch the class video on the blog as well. Any questions on this? Y'all see why it's my favorite question? Just everything in finance is in this one question. I love it. It shows if you're really, really capturing all your other classes. All right, any final questions on the exam?